All right, let's talk about something that's on every investor's mind. How do you protect your hard-earned cash from a big market crash? Today, we're going to dive into a strategy that's basically a literal insurance policy for your stocks. I mean, this is the big one, isn't it? It's the question that keeps you up at night. You know you need to stay invested for the long run, but that fear of another 2008-style meltdown, it's always kind of lurking there in the back of your mind.
So, a really common strategy people use is called trend following. The idea is you have rules that tell you to sell when the market starts to drop. The problem? It's always a little late to the party. And in those really choppy sideways markets, you just end up selling at the bottom of a dip and then buying back in when it's already higher. It's this nasty thing called whipsaw, and it's just a slow, stressful way to bleed your account dry.
So let's just forget all the complicated rules and the second guessing for a minute. What if you could just draw a line in the sand? What if you could get a contractual guarantee that says, nope, my portfolio cannot fall below this number? Well, it turns out you can.
And that brings us to the core of this whole thing, using something called put options. And honestly, the best way to think about them is exactly what it sounds like. Real insurance for your portfolio. The analogy is just perfect, and it makes a complex idea feel really simple.
Okay, so let's get into it. A put option is just a contract. That's all it is. You pay a small fee, and in return, you get the right to sell your stock at a price you both agreed on ahead of time. And notice I said the right, not the obligation. It's your choice, your safety net. And what's really cool is how the lingo lines up perfectly with regular insurance. The premium is, well, your premium. It's the bill you pay for the protection. The strike price, that's your coverage amount. It's the guaranteed price you can sell at. And the expiration is just the term of your policy, how long it lasts. So here's the most important part. Remember that whole whipsaw problem with trend following? The lag? With options, that's just gone. The instant your stocks drop below that guaranteed price, your protection kicks in. It's immediate and it's written down in a contract. Now, I know what you're thinking. This all sounds fantastic, but what's the catch? What does this peace of mind actually cost? Let's walk through a real-world calculation and find out the price of certainty. Okay, let's imagine a scenario. Let's say you own 300 shares of SPY, the big S&P 500 index fund. Your whole position is worth a little over 200 grand. And your goal is super simple. You want to guarantee that no matter what happens, you can't lose more than 30% over the next year. That sets our guaranteed sale price at $480 a share. Okay, so this is our starting line. $206,700. That's the nest egg we're looking to protect. And to get that 1-year, rock-solid guarantee on the whole thing, here it is. The bill comes to $2,040. That's the total premium you pay up front for a full year of sleeping soundly at night. But here's where it gets really fascinating. When you put that cost into perspective, $2,000 feels like a chunk of change, but as a slice of your portfolio, it's just under 1%. 0.99% to be exact. So you're basically paying a 1% annual fee for an ironclad guarantee against a financial catastrophe. And here's how it plays out. Let's say the market absolutely tanks and SPY plummets to $300. Doesn't matter to you. You have the contractual right to sell all your shares for $480. Even if it just dips a little to $470, you still get to sell for $480. And what if the market soars to $900? Fantastic. You can just sell at the market price or hold on for more gains. The only thing you've lost is that 1% premium you paid for insurance you, happily, didn't need. So this sets up a really clear comparison. We've got two completely different ways to handle risk, and each one comes with its own very specific kind of cost. On one side, you have put options. The cost is certain. It's explicit. It's right there on the price tag. You pay that roughly 1% premium year in and year out. And in return, you get certainty, a hard floor on how much you can lose. On the other side, you have trend following. The cost here is kind of sneaky. It's uncertain and implicit. You pay for it with those whipsaw losses and, frankly, the emotional stress of false alarms. Now, this isn't to say trend following is just bad, period. The source material points out it can actually work pretty well for things that are less volatile, like bonds. But yeah, it really has a tough time with individual stocks. The main takeaway here is that it's not an either-or decision. You can actually combine these strategies. And that really brings us to the most important question. This isn't about which strategy is technically better. It's about figuring out which cost you, personally, are more comfortable paying. I mean, this quote from the source material just sums it all up perfectly. There's no free lunch. You are going to pay for downside protection one way or another. The only question is, do you want to pay an explicit bill, or do you want to pay with an unpredictable drain on your money and your sanity? So at the end of the day, it really boils down to your personality as an investor. Would you rather pay a known price, about 1% a year, to sleep soundly at night, knowing your absolute worst case is already defined? Or would you rather avoid that fixed cost, and in return, accept the emotional roller coaster and potential hidden losses that come with a more uncertain strategy? And really, that's the question we want to leave you with. In the world of investing, managing your risk always has a price tag. The only choice you have is deciding which one are you more willing to pay.